All right, let's dive in. We're going to talk about a real investing classic today, One Up on Wall Street by the absolute legend Peter Lynch. And let me tell you, his main idea, it's going to flip everything you thought you knew about the stock market completely on its head. I mean, it's the big one, isn't it? Can a regular person, someone like you or me, actually beat the Wall Street hotshots at their own game? We're always told that the pros, the folks with the fancy degrees and the supercomputers, they've got it all figured out. But Peter Lynch, he had let's just say, a very different opinion. And boom, there it is, right from the man himself. Lynch's whole argument is that you, yeah, I'm talking to you, actually have a natural, built-in advantage over the pros. So what on earth is he talking about? Let's get into it. Okay, so this is Lynch's first, and honestly, his most powerful idea. He says your biggest, most unbeatable advantage comes from something you already have. It's the knowledge you pick up just by living your day-to-day life. He literally calls this your amateur's edge. And it really is just about paying attention. You know when you're at the mall and you see a line at the door for some new store? Or you're at work and a new piece of software is making everyone's job 10 times easier? That right there is a hot tip. It's on-the-ground intel that Wall Street might be clueless about for months. And the classic story that proves this point is all about legs pantyhose. Seriously, Peter Lynch's wife, Carolyn, was at the grocery store and just noticed how these things were flying off the shelves. She told him about it. It was such a simple, real-world tip. So what did he do? He looked into the parent company, Hanes, and sure enough, the stock became what he called a six-bagger. It went up 6 times. A total home run. And it all started with a simple trip to the supermarket. Okay, but here's the really crucial part. Lynch is super clear about this. That amateur's edge, that's just the starting gun. It is not the finish line. Liking a product is a great reason to get interested, but it's not a good enough reason to just go out and buy the stock. That initial tip is your cue to roll up your sleeves and do the homework. You got to check the numbers and see if the company is actually financially solid enough to justify all that buzz. So, okay, you've used your edge, you've found a lead. What's the end game here? Well, this is where we get to maybe Lynch's most famous idea of all. See, he wasn't just trying to find good investments. He was hunting for the ones that could literally change our life. He came up with this amazing term, the 10-bagger. It's a stock that goes up tenfold, 1,000%. And the crazy part is, if you can just find 1 or 2 of these in your entire investing career, it can make up for all the duds, all the mistakes, and then some. And just to show you how insane the math is here, Lynch lays it out for us. So look at this table. Portfolio A, it's fine, right? A solid mix of well-known stocks gets you about 163% gain. Not bad. But now, look at Portfolio B. It's the exact same portfolio with just 1 stock added, Stop and Shop, which was a 10-bagger. And look what happens. That one single winner launches the total portfolio gain to over 1,000%. It's just incredible. And that brings us to this really powerful idea. You don't have to be right all the time. You don't need a portfolio where every single stock is a winner. The math of just one massive home run is so powerful, it can basically erase all your other mistakes and still leave you looking like a genius. All right, so the big question is, where do you actually find these monster stocks? And the answer is another classic Peter Lynch move. It's totally counterintuitive. You find them in the places nobody else is even bothering to look. Think about it. Wall Street gets all excited about the next big thing, right? Hot industries, complex tech, tons of media hype. Lynch, he ran screaming in the other direction. His perfect company, well, it sounds boring. It has a dull name. It does something simple, maybe even a little bit gross. And the reason is simple. When a company is boring, nobody's paying attention. And when nobody's paying attention, you can often buy it for a fantastic price. I mean, check out these examples. Crown, Cork, and Seal. They make bottle caps, not exactly a thrilling business model. Service Corporation International, they're in the funeral business. You can bet that's not what analysts are gossiping about. But that's the whole point. That complete lack of glamour is a massive competitive advantage. It means new competitors aren't rushing in, which lets a great company just quietly take over its entire market for years and years. All right, so let's say you did it. You used your edge, you found a promising company, and maybe it's even a little boring. What's the next step? According to Lynch, you absolutely have to know what kind of company you're investing in. You have to put it in a category. And he lays out these 6 basic categories for us. For example, you've got your stalwarts. These are your big, reliable giants like Coca-Cola. They're great to own in a downturn, but they're not going to be 10-baggers. The real excitement, the potential for those 10-baggers, that's where the fast growers come in. These are smaller, hungry companies growing like crazy, maybe 20% a year or more. And it's so important to know which bucket your stock is in because it tells you what to expect from it. Putting a stock in a category is really like figuring out the first chapter of its story. It tells you what kind of plot to expect. You wouldn't expect a slow grower to suddenly turn into an action hero. And you wouldn't be surprised when a cyclical company has its ups and downs with the economy. Knowing the story, the right story, helps to keep your cool and make smart decisions instead of emotional ones. And all of this, it leads to the final and maybe the most crucial piece of the whole puzzle. It's your mindset. Because honestly, you can do all the research in the world, but if you don't have the right mindset, none of it matters. Lynch had this famous quote, and it's just perfect. He said that in the stock market, the most important organ isn't the brain, it's the stomach. And what he meant was that your ability to just hang on, to not freak out and sell when the market drops, that's what really separates the winners from the losers. It's not about being the smartest person in the room. It's about having the guts to stick to your plan. And if you want to see the real cost of panicking, look at this number. Lynch points to a study from the 90s. If you tried to time the market and just happened to miss the 30 best trading days over a 5-year stretch, you would have lost out on more than $187,000 in profit. That's the devastating price you pay for trying to be clever and jump in and out. And here's a fantastic real-world example, the pharma giant Merck. For almost 10 years, from 72 to 81, the stock price did nothing. It was totally flat. Most people would have given up and sold. But here's the thing. Behind the scenes, the company's business was growing and growing. And the people who had the stomach to just hold on, they were eventually rewarded in a huge way when the stock finally woke up and shot up 4-fold. So at the end of the day, it's pretty simple. Success is about finding great companies and then just giving them time to do their thing. As long as that original story you fell in love with still makes sense, a lot of the time the absolute best thing you can do is nothing at all. And that's really the heart of Peter Lynch's message. The next huge investment opportunity, it's probably not buried in some dense Wall Street report. It's way more likely that it's hiding in plain sight, at your job, in your local grocery store, on your commute. The only question is, are you paying attention?